I'm Adam Grimes, and welcome to Module 4, Unit 3 of the Art and Science of Trading. So, the title's intended to be a little bit humorous. Where'd your charts go? Everything we're doing here is very focused on charts and using charts, and we've talked about the reasons why that's a valid approach. But I want to show you another way where much of this next module, of this current module, is going to be focused on looking at some quantitative tendencies in market data. And a lot of the people who do this work don't use charts. One of the things when I started doing quantitative work, I started to wonder, how are people looking at data if they're not looking at charts? I want to answer that for you. Charts are very useful representation. There are all of these heuristics that we can do, which are basically think of them as mental shortcuts. Basically, we can see things on charts that might be very difficult to pull out from a quantitative perspective. This is why we work with charts. But also, charts have a bad reputation, particularly in many academic circles in some parts of the world. And one of the reasons, I think, is because traditional technical analysis has some things in it that, frankly, some of those things are kind of silly. Some of the chart patterns and the ways of approaching it is a purely visual discipline without any academic or statistical rigor. That's a problem. What we're doing with our work here is kind of blending both. But just be aware that some people have a really bad opinion of charts. And let's take a few moments here. We'll do this quickly and just look at other ways that people might look at data. So this is what raw market data looks like. It was already aggregated into time periods. We've talked about the ticks, but these are daily bars. And you can see our data points are pretty much, we have open, high, low, close. There's volume. There may be, for some markets, open interest associated. And that's pretty much it. This is market data. Now, it's possible that we could also have, the question is, are we looking at transactions or are we looking at quotes? If we're looking at quotes, then we can also have bid-ask data, which may or may not represent trades actually made, and all of these things are time-stamped. In this case, because it's end-of-day data, we just have a date. If it's intraday data, maybe time-stamped down to the millisecond. And there can be other pieces of information. One of the others that I might think very quickly would be exchange. Depending on the particular market you're trading, a transaction could have an exchange stamp. But with all of those possibilities and complications, the vast majority of financial data, and you could be forgiven if you simplify it to this, is open, high, low, close, perhaps volume, and open interest, time-stamped. That's the data we're looking at. The first step of most quantitative analysis is to convert prices to returns. And when I use the word returns, I get a lot of questions from technical traders. What is a return? Simply percent change. So all we're doing is taking the price at one time divided by the price of the previous time minus 1. There's something called a log return that if you read the literature, you'll see people use. There's some good reasons to use them, but if you don't know what I'm talking about, you don't need to know what I'm talking about. You can just work with returns. The point of using returns, and I could equally say the point of using percent changes, is that this normalizes market action. So whether we have an asset where the price is $10,000, or we have an asset where the price is $1. Imagine you have two assets here, A and B, and both assets go up $1. On a $10,000 asset, that's insignificant. On a $1 asset, it doubled, which is huge. So this one thing that a return does automatically, it normalizes market action for price level. Let me just say, looking at market data from a quantitative perspective is generally done on returns or sometimes on changes, which would be subtracting. But there again, it's not really normalized for price data rather than prices. So that's one of the critical differences in quantitative analysis and technical analysis. So once we have returns, once we've created our return series, which is very easy to do, what do we do with that? Well, we can just do basic statistics, figure out the average, figure out the median, figure out standard deviation, stuff like that. We can also look at the return series because these things are time-stamped, so we can line up events in other markets, and we can look at correlations and how they might connect or influence or lag or lead other markets. We also can, it's kind of funny because even in this quantitative work, which generally speaking the people who do this shun charts, one of the things we discover is it's very useful to graph data. It's very useful to look at data visually because we can see things that you might not see in numbers. And here is the return distribution for what was at the time a fairly wild stock and for the S&P 500. And these are percents on the bottom. So you have negative 20 and positive 20. And look, these are, I believe, I would not swear to it, but I believe these are daily returns. And look at the spread here of Lulu while the SPY lives here. So you can see that one has a lot more variability. The SPY, so much of the data clusters right around the middle. And with Lulu here, less does. So looking at volatility, here are two examples of these are random numbers generated around a line, and one has the empty dots has a lot more spread, meaning that the standard deviation, one way you could think of it with markets, maybe the volatility is higher. And if this, see the line hidden behind there? If that's actually the true center, then look how far some of these hollow dots fall from the center, while look at the less variable, everything clusters much closer. And this is the types of relationships that we can see when we start to compare things. We also can look, these are weekly returns for a couple years, and what we're looking for here is some type of line relationship. So you can see here the stock ABX is rather heavily influenced by gold, and perhaps less so by the SPY because the clusters around, and perhaps maybe not at all or maybe a little bit by the dollar. You shouldn't just draw, these lines need to be drawn analytically rather than just kind of casually as I have. But that's what we're looking for here. We're looking for whether the dots kind of fall in lines or shapes or whether they're just some big clustery mess. And this is a way to show how different markets influence each other. These are the kinds of things that we can do visually. Another thing is to do something called an event study methodology. And this becomes very important for some of the other things we're going to do here over the next few weeks. This is not complicated. What we do is we define a condition and we see what happens after. And our condition could be something quite complicated. It could be very simple. The condition could be as simple as today's close is lower than yesterday's close. We could add indicators or different calculations, but we just define some type of trigger condition that we want to study, and then we track what happens after. There are some other things we consider like variability and statistical significance, but this is the core of the methodology right here. We've also talked a little bit about models. Models are representations of reality, simplifications, and a lot of quantitative work is designed to create these models. There are a lot of different ways to do this, but you will hear, perhaps less so in recent years, people will talk about factor models. This is a thing in portfolio creation where we look at how markets move and we try to understand what factors influence it. I'll throw some things out there. Interest rates, price of gold, GDP, other measures of business condition. And we try to understand how important those markets are and create a model that says when this happens in the future, here's how we think markets will react. And we've talked a lot about models. This is a different kind of model, but I think we've discussed the issues and limitations and how important the assumptions are in a model. A lot of quantitative work has gone into understanding risk. This is going to be something that we talk about more and more through the rest of the course because it's a complicated subject, and it's a word that everybody uses, and we think we know what it means, and usually we do, but there are probably risks that we don't understand very well. There are a lot of quantitative techniques that put trading methodologies or patterns or portfolios under different types of stress run a lot of what-if scenarios, what if things go crazy, and we can do many thousands, hundreds, millions even of simulations and understand how likely different scenarios are. So basically what we're doing is driving towards some kind of expected value. There's that concept again. And with a lot of this, some of these are pretty deep questions, and they really are questions that hover right at the edge of what we do know and can know. Here in 10 minutes, we've just scratched the surface. But what I want you to take away from this is that there are ways to look at data that, other than the charts. And they generally begin by converting to returns and then looking. Basically what we're doing is the same thing. We're looking for patterns and trying to understand what those patterns might say about the past and about the future. Most of these analyses are not really complicated. It really does come down to finding those patterns and figuring out what's the likelihood that will persist in the future. And this is one thing that is pretty much second nature to people doing quantitative work, not so much to most technical traders. And I would gently suggest that if more technical traders think this way, ask questions, think critically, and then look at the data. Ask the data. The answers are there in most cases. If we go through this process of really asking critical questions, asking hard questions, thinking hard about those questions, and driving toward answers instead of making assumptions, that would make all of us better traders. I'll see you back for the next unit. Thank you.